Greetings, folks. My name is Dave Evans. I am the president of Evans Financial Group here in Shreveport. And we're going to have a discussion today about three different kinds of money. The first kind of money is taxable money. Now, what do we mean by taxable money? Taxable money is anything that you get from the financial institution at the end of the year, something called the tax form 1099. So you have to pay taxes on that money. Now, who gives us these? Well, banks. Maybe you have a CD. You know what that is, right? That's a certificate of disappointment or money market or something like that. Perhaps a brokerage account at a wirehouse. So maybe you got dividend income or capital gains or something, but you got a 1099 form from that financial institution. What is the good thing about this type of money? Well, the good thing is it's liquid, and I can get to it. Now, most financial planners, we all don't agree on the same thing. But one thing that most people agree on is that you should have about 6 months of, I want to say, bills in this type of account that you can get to. We've heard people say, well, I need money in case of an emergency or an opportunity. And that's where we would get that type of money. The second type of money that we can have is tax deferred. Tax deferred money. An example of that would be like IRA, traditional IRA, 401k, TSP, which is the government's version of 401k, 403b, that's for nonprofit organizations. Any type of plan that either you put money away, like here, or the employer put money away and you haven't paid taxes on it. People think it's tax deductible. It's not really tax deductible. It's just tax delayed or tax deferred for some time in the future. Now, would it be a good idea to have $1 million in this type of account? I don't know. It sounds like it would be. Well, maybe not. You really shouldn't have more in this type of account so that when you are retired and you have to start taking required minimum distributions, which now that age is age 72, that your required minimum distribution equals the standard deduction on your tax form. See, we don't have as many tax deductions, if you will, at retirement time. So many people, their house is paid for, so they're going to take a standard deduction. If your required minimum distribution equals your standard deduction, which is about $26,000 in retirement, what's your tax bracket? 0, right? Anything more that's in this bucket or this type of account should maybe be put over here in something called tax-free. What do we mean by tax-free? Now, tax-free, does that mean free of all taxes? Yes, free of income taxes from the federal government. What about state taxes? State income taxes. So we want it free of state income taxes. Now, people sometimes will buy municipal bonds thinking that municipal bonds are income tax free. Is that true? Well, they are federally income tax free, but they may or may not be income tax free from the state because they are, if they're not from the state that you're domiciled in, that you live in, they're not income tax free. Now, I don't know why I would do this, but if I bought municipal bonds from the city of Chicago in the state of Illinois, they might be free, the income from that might be free from federal taxes, but it's not free from from Louisiana income taxes. Does that make sense? Okay. But what about long-term capital gains? or capital gains, even short-term capital gains. Can I be taxed on municipal bonds? Let's say they're Louisiana bonds, they're free of income tax from the feds, they're free of income tax for the state, but could I pay capital gains tax on those? Yes. If I bought a bond and it's worth $10,000, and because of change in interest rates, now the actual value of that bond is $11,000, then I sell it, I would have to pay capital gains. So when we're talking about tax-free income, we're talking about tax-free from federal income tax, state income tax, and capital gains tax. Okay? Now, what qualifies for this? Well, in an ideal world, Social Security qualifies for tax-free. Perhaps when you were younger, you bought a Roth IRA. Now, a Roth IRA is you put money away into this vehicle, but you didn't deduct it. And it grew on a tax-free basis, and when you went to take it out, if you follow all the rules, the money that comes out of there becomes income tax-free. Or Roth conversions, meaning you had an IRA and a traditional IRA, and you deducted it earlier on, and then you converted that to Roth by paying taxes on it at some time in the past. Ladies and gentlemen, I did this in 2011 and 2012. I converted a lot of my IRA money to Roth. Now, I've passed the 5-year rule and I'm over 59 and a half. So now as I take money out of that IRA, it is income tax free to me. It's income tax free to my family, and it is income tax free when I pass. And when I take money out, it is not subject to the calculation to determine do I have to pay any income tax on Social Security or not. So now, you may not even think about this, but today taxes are on sale. So this might be a good option. It's possible if you have if you're still working and you have a 401k, that your employer, in part of their 401k plan, allows you to have a Roth option. Ladies and gentlemen, I'm going to tell you that's a good deal to put money into a 401k. You don't deduct it or defer it, but it's going to grow income tax free on the contributions that you made and the earnings that they made. Another thing that's income tax free would be something called life insurance retirement plan. Now, when I came into business, literally 50 years ago, we had two different kinds of insurance. There was permanent, like whole life, and there was term. There's variations of permanent. There's 20 pay life and endowments and so forth. But for the most part, that was all that was out in the marketplace, and that's what we offered. Today, they came up with, over the years, the universal life and variable life, and just the products got, believe it or not, significantly better for the consumer. This one that is in the marketplace today has some benefits that we didn't have way back when. One is, if you pass away, it's tax-free death benefit. That's pretty much always been the case for life insurance. But it also has a long-term care benefit. When you get to be in retirement time, you get to thinking about long-term care issues. Am I going to have to go to a nursing home? Well, there's a couple ways you can buy long-term care. They're expensive almost at any stage, but if you can include it in this, and it's not like buying an $8,000 long-term care premium, it's a pretty good deal. The third thing that comes with this is tax-free income. Under Section 7702 of the Internal Revenue Code, it says that if we take money out of this life insurance retirement plan, as we take that money out, that money comes to us on an income tax-free basis. And tax-free is, again, what we're trying to establish here is a good way and to minimize any taxes that are going to the feds. You know, the Bible says, render unto Caesar that which is Caesar's, and I believe in that. I just don't want to render unto Caesar that which I don't have to by structuring my assets in a certain way, and that's what really we're talking about here today. If you hadn't had an opportunity to do that, I'd like you to download our free report, Are You Paying Too Much Taxes in Retirement? Now, if you click on the link below, you can download this report. It's free, and it'll give you some information, some of the things that I've talked about here today on how to minimize and mitigate taxes in your retirement. My name is Dave Evans. I'm with Evans Financial Group, and thank you for watching our video on 3 buckets of money and how to reduce taxes in retirement.